Moving average trading strategy. Best exponential moving average. How to trade step by step. In this moving average trading strategy video, we are going to discuss why we've developed our own moving average, as well as how we've paired the moving average to a very specific set of entry rules, which over the past few years has turned our moving average pullback setup into one of our most consistent, high probability trading strategies to date. By the end of this video, you will have all of the tools necessary to trade this setup consistently and profitably on your own. We're going to go through that strategy step by step, starting now. One common misconception among traders is that a moving average is a good spot to take trade entries off of. But while simply buying or selling off of the moving average will award you some winning trades, in the long run it will not be sufficient enough to sustain profitability. The bad news is that the moving average itself will typically only give you a 50% chance of winning the trade. The good news is that we can eliminate some of those false signals through a specific set of rules which will turn a below average setup into a dependable, high probability trading strategy. Lesson 1. Moving averages. So why do we even use moving averages? Well, moving averages can actually be very beneficial in trading. While the moving average itself is simply a representation of the average of past prices, we can use this data in a couple of different ways. First off, moving averages will make it clear and easy to identify when price is trending. In a trending market, price will continue to pull further and further away from the moving average as the trend gets stronger. We also know that price will never just go in one direction. It will eventually need to take a breather as the long traders take profits and new buyers come into the market. So, once price has made a significant move in either direction, we are then looking for a price to pull back towards the moving average. Furthermore, we will typically be looking for long trades as the price is above the moving average and trending upwards, while looking for short trades as the price is below the moving average and trending downwards. The second useful signal that a moving average can give us is the change in trend. A change in trend may be occurring as the current price goes through the moving average, retests the moving average, and continues to trend in the reverse direction, ultimately reversing the previous trend. For the purposes of this moving average pullback strategy, we will be focused only on trending prices as it relates to the moving average. We are first looking for a trending price to pull away from the moving average, and then ultimately waiting for a pullback towards the moving average. Pro tip. You should always be looking for trades that are with the trend, as you will undoubtedly find out that trading with the trend is much more reliable and ultimately profitable than reversal trading, especially for newer traders. It is much easier to swim with the current than to try and swim against it. Now, while there are different commonly used moving averages, which will all be suited for different situations and different traders, generally speaking, the faster moving averages like the 9 or 13 period would typically be best suited for shorter term scalp traders on the intraday frames like the 1 minute or 5 minute. While larger moving averages like the 100 and 200 would mostly be suited for investors and long-term swing traders working off of the daily and weekly timeframes. However, all moving averages work on all timeframes. Some moving averages are better suited than others for different timeframes as well as different situations. The 20 period and the 50 period moving averages are probably some of the most widely used averages. If you have no idea where to start with moving averages, I can almost guarantee you that the 20 or 50 period moving average will fall right into place in your trading. The 20 and 50 period exponential moving averages have been my preferred averages for years, and now we even use a modified version of the 20 and 50 that we've created for our own trading, which will be discussed further in part 2 of this series. Part 2 of this series goes into further detail on our moving average, the entry setup, as well as stop losses and targets. I'll link to that video below in the description. However, for the purposes of this lesson so far, we will be using the 20 and 50 period exponential moving averages as a zone. The moving averages are used to identify when price is moving away from its average, not as a point to buy or sell off of. We are going to be using the 20 to 50 period moving averages as a zone, and this will show us not only when price is pulling away from the averages, but also a general location of where to expect price to pull back to once the current leg up is ready to take a breather. So now, getting into how we will be using this average zone to look for trade entries. The first thing that we need for this setup to take place is a divergence of current price from the moving average like this. This is part of the reason that this setup is one of my favorite setups to trade. It's extremely quick to scan for and easy to identify. So the first thing that we do every morning is to scan through our watch list of stocks, futures, forex, or crypto, looking for this divergence in current price from its moving average. As price begins to run and pulls away from its moving average, it is inherently trending, and while a trend is technically defined as higher highs, charts will have a hard time not trending when price is pulling away from the moving average. And as a result, this will ultimately leave price in need of a resting period in the near future, more commonly known as a moving average pullback. So as simple as it is, that's the definition of the first rule for this setup. Rule number 1, screen for prices that are diverging from the 20 to 50 moving average zone. So now that we've found some setups that have made a run, pulling away from their moving averages, we have then added them to our watch list. We need to identify exactly where price is going to pull back to in order for us to have a high probability entry point. The way that we will define this entry level is through key trading levels, a form of support and resistance that have more strength, more significance, and more reliability than traditional support and resistance. Lesson 2. Key trading levels. The second lesson of this series is focused on stacking key levels with the moving average zone that we discussed earlier, to more precisely locate the where of where a trade is most likely to take place. The first thing to consider is that key trading levels are not just simple support and resistance levels. While support and resistance is a vital part of trading, plotting every single line of support and resistance will leave your charts cluttered and riddled with false trading signals, which ultimately lead to indecision and misinformation in your analysis. By locating high target levels of support and resistance, we are able to eliminate the majority of the false signals while giving ourselves the most probable and profitable trading levels possible. While plotting levels on the charts that you are trading will give you the simple areas of support and resistance, the way that we are going to locate key trading levels is by zooming out of the smaller picture that we are currently looking at and taking a look at the bigger picture inside of a larger time frame. For example, if we are doing our analysis and looking to take trades off of the 1-hour time frame, what we do is zoom out to get a bigger picture of what price is doing. We will look at the daily or even weekly time frame levels of support and resistance. This way, we are using more established, well-respected levels which hold more weight and are therefore more reliable levels to take trades off of. Once you start plotting your key levels like this, you are going to see a dramatic increase in the reliability of your support and resistance levels. Once we zoom back into the original time frame, we will be able to see key trading levels which provide us with more consistent trades and more accurate trade entries, while also eliminating the majority of noise that standard support and resistance would have created. You can see that these levels are well respected, and most importantly, they won't interfere nearly as often with the other trades that you have entered from the surrounding trading levels. In other words, there is now more space to trade in between these levels. While traditional support and resistance would only have minimal gaps between them, which are nearly impossible to trade between, key levels will have space to trade with more consistent and reliable reactions to those levels, perfect for revealing reliable trade entries as well as additional stop loss and profit targets. To better understand these trading levels, it is important to remember that the longer the time frame, the stronger the signal will be. While the daily chart is very strong, the weekly chart will be even stronger. This is crucial to understand on the intraday time frame as well. While support and resistance on a 5-minute chart exists, locating and charting the support and resistance on the daily and then zooming back into the 5-minute chart will give you only the levels at which price is most likely to react off of. You can always start by just placing these levels directly around the current price both above and below, and then slowly add them to the rest of the chart over time. One thing to remember is that these key levels are always well respected. Once you have plotted these levels, they should stay in place. You can use these levels to take trades from. You can use them to stop from entering other setups as well as use them for creating different stops and targets for any and every setup that you could possibly trade. They work and are respected all day, in every time frame for every trade setup. Here's a pro tip. The longer the time frame, typically the easier it will be to trade. For example, while the daily time frame would be one of the simpler time frames to trade from, the 1-minute time frame will be one of the most difficult to trade from. Intraday trading is much more difficult than swing trading the 4-hour and daily time frames. If you are struggling to bring in consistent profits, try to work off of the longer time frames like the daily. Dial back your position size and take less risky, smaller positions that play out over a longer period of time. Not only is a daily chart more reliable to trade off of, but the smaller size and slower trades will allow you to manage real money trades at a more comfortable pace, while reducing the stress of being heavily leveraged. This will also help you to build the confidence that you will need when you return to trading bigger positions on the shorter time frames. Recapping the rules. Number 1. Price makes a move far enough away from its moving average that it allows us to identify the opportunity for an upcoming pullback. Number 2, we plot our key levels, focusing on the key levels which occupy the area directly on or near our moving average zone. Number 3, we wait for price to pull back towards our moving average zone. Number 4, price reacts to our key level inside of our moving average zone. We have identified a high probability trade setup when the price pulls back to the moving average, if and only if a key trading level is also present at or near that price. Price does not have to hit the moving average, however it does have to hit the key level. While the moving average is also present at this price, the key level is the more important signal. Part 2 of this series will go more in depth on our moving average as well as our complete entry strategy. So, stacking these two areas together is the indicator to giving us high probability levels at which trades are most likely to take place from. Being disciplined enough to take trades only when at these levels is going to be up to each individual trader. So now that you have the rules in place to stack these two levels, all we need to do now is screen for the setup and take trades off of these levels, right? Well, sort of. While adding these two levels together will give us some fairly consistent winning trades, we will get significantly more consistent trades when we know exactly when a trade presents itself. Where a trade is taking place is covered with the key trading level. Understanding when a trade is taking place is the result of a good entry strategy. This also allows you to be confident in the trades that you enter. Essentially, it tells us that the price is moving now, giving us the green light to take the trade now. If you are interested in watching part 2 and learning more about our entry strategy, as well as our moving average, please feel free to do so on our website through the link below in the description. Please don't forget to like and subscribe if you learned something new. Also, don't forget to save this video in your trading folder so that you can revisit us in the future. An occasional refresher on this material will only help to solidify these concepts further. I wish you the best of luck in your trading. Always remember to trade safe, trade smart, and trade profitably. Thanks for watching, and happy trading.